It's time to chain up your expectations and throw away the keys. You're on the threshold of the Get Seen, Get Sold podcast, where sugarcoating is for donuts, not deals. Here's your host, the renegade realtor who tears up the rule book and feeds it to the termites, Mike Rady. Brace for impact. It's about to get real.
What's up, everybody? It's Mike Rady, Get Seen, Get Sold. How are you on this hot as hell what is going on in New Jersey day? Yesterday it's freezing, and then the earth's disappearing with the sun, the moon, all sorts of nonsense. I don't know. It's crazy. The little cicadas are going to be coming up soon. Maybe we're in the rapture. I don't know. Maybe that's why we got rates where they are and things that are going on the way they are. So today I'm bringing in a mortgage expert. And when I say a mortgage expert, I mean this guy is a mortgage expert. He's got a financial background. He didn't just go to mortgage school and pass the test and just started handing out loans, you know, in the back alleyway or anything. He's tried and true. He's the face of the Lending Pro team over at Greentree Mortgage with his partner over there, Harris Scheckman. So I'm going to bring in here Mr. Bob Finsterer. All right. Hey, Bob. How you doing?
You got the right number of ers at the end there.
Yeah.
So
anyway,
Bob, Mike, hey, thanks for having me. It's great to be here. And look, I always love to share what I know, and I'm just glad people want to listen. So
no, you know what? I'm glad you came on because you're a busy guy. So for folks that don't know Bob is just not helping folks with their mortgages and setting them straight on what they need to do to get lined up for a mortgage. He doesn't necessarily give them credit advice, but he'll lean them towards the right direction. But Bob's also an educator. Bob educates other lenders, in his office and his peers, but he educates real estate agents. And that's very important because one of the biggest issues that we have with real estate agents is a lot of them talk about shit that they don't know about. They get it wrong. And then, when they talk to people like Bob and Bob says, no, this is the way it is. Then they call the agent and go, you told me this, and that. And Bob's a jerk because he said I can't do this and everything else. So it's important that, we have folks like Bob that educates the realtors because, we're not the money people. When my clients say to me, hey, Mike, what's this going to cost me or this or that? I said, I don't know. You got to call the money guy. Call the money guy. I know enough to tell you to call the money guy. Here's his phone number. Give Bob a call. Call his partner, Harris. I said, the phone's going to ring. One of them's going to pick up. And it's going to be good. So, Bob, what actually, let's start with, how long have you been in the mortgage business now?
You had to ask me that question. I literally started the week after 9/11. So add that up. It'll be 23 years in September. I've been in this business.
Okay.
So.
Okay. Now, I just I was sharing with everybody the education piece. Have you been doing this education piece with realtors for a long time, or is this something new that you developed? I mean, obviously it's some advantage to you, right? Because you're getting more educated realtors working with you, and hopefully they give you more referrals. But where did that come from, all the education?
It really came from the fact that continuing education was not a thing. Real estate agents prior to the financial crisis were not required to take continuing education in order to renew their real estate license. Then in 2012, new laws went into effect. I think it was mandated at the federal level, but every state had to put continuing education requirements into place. And I thought, wow, this is, the majority of the business that I got then and the majority of the business that I get now is referred to me by real estate agents. So I took the opportunity to take what I know, put it down on paper, submit it as a class to the state of New Jersey, submit my credentials to get qualified as an instructor. Now, one of the things that I like about it is that when you submit a class for continuing education credit, there has to be consumer benefit to it. In other words, I need to educate the real estate agents about some aspect of the mortgage business that affects the real estate business, which is most aspects, and do it in a way that provides a consumer benefit. And to me, consumer benefit, the real estate agents are out to make sales. You got to close deals to make money. But at the same time, you get introduced to customers and you get repeat customers because of the quality of the service that you provide. So to me, consumer benefit goes hand in hand with sales production and sales results. If you're doing the job well, like a professional, taking really good care of people, advising them well, educating yourself and really paying attention to the continuing education that you're provided, that consumer benefit piece that you can pass on the clients helps you get more business. Your clients better satisfied, making better decisions, more likely to refer you to friends and family and come back to you in years down the road. So I really love it. I really love it for those reasons, because it just dovetails with my own personal philosophy of this business and enables me to meet a lot of real estate agents that share those values.
Yeah. So, with being in the business 23 years now, anybody who sticks to any type of, an industry or business, they have to love it. I mean, you're not going to stay somewhere you don't like. And then, what I'm hearing most important is something that's very tried and true with me is it's the customer service that we give is key. Mm-hmm. We got to take care of our clients. I don't care. I was talking to a gentleman that owns a moving company today, and, right along the same lines, what Bob does, what we do as real estate agents, what this guy does, what the restaurant owner does, your customer service has to be on point, has to be key. That's what cracks the code to do good business and continuing business. If you're looking to just rush and get a deal done and not focus on where, what's going to be down the road for those people, and you're short with them and you don't take care of them, they're not calling you back. They're not referring you to anybody else. You can't pay for the exposure that referrals give you. Referrals are the greatest thing ever. I know we don't get probably the amount of referrals we can because, if you give bad service, they shit all over you everywhere. There's no doubt about it. So it's a little harder to get referrals, but when you do a good job, and they do end up giving that referral, it does go a long way, and it means a lot. That's a testament to what you did with the last client, and that's key for me. So
yeah. Absolutely.
Yeah.
Look, if I can say something, if you look at my business card, if you look at how I brand myself, it says loan officer extraordinaire. And, it sounds a bit like a boast, but it's not. For me, I put it there. It started as a bit of a joke, having lunch with a person in the title business, sort of joked about, hey, it's funny, I was having, I think my card at the time said senior loan officer or vice president or something. And he said, yeah, I was having breakfast with someone yesterday who, 2 weeks ago was serving me an Egg McMuffin at McDonald's, and today has a business card that says senior loan officer. So we're like, how do I distinguish myself? And we came up with loan officer extraordinaire, and he kind of dared me to put it on my business card. So I took up the dare. I did it. But I love having it there because it is an aspiration. I have to live up to that every single day. And thankfully, this really hasn't ever happened to me that someone says, loan officer extraordinaire, you really blew that one, ha ha, loan officer extraordinaire. It doesn't happen because I know it's there, and I know I got to live up to that. If I'm gonna put that out there, I'm gonna do the job. I gotta walk the walk if I'm gonna talk the talk. So
I will say that you do, and I definitely can say you do, not just because you and I have worked together on other deals for clients, mutual clients, and everything else. But my family has personally used your services. So the fact that I would come to you with my inner financials and stuff like that means I have a lot of trust for you. And getting back to what you said, the loan officer extraordinaire. Some people might say, well, that's kind of like a flex or something. Like on my business cards, other than it saying get seen, get sold, it says real estate expert. It doesn't just say real estate associate or real estate agent. I'm the expert because I've put the 10,000 plus hours in. I've worked the deals. Yeah. I get up in the morning. I live and breathe this job. It's sickening for my wife. Sometimes I feel bad for her because I talk real estate all day long. I pitch to waitresses, bartenders, Uber drivers. I'm constantly pitching, but that's my job. This is what I live, and this makes me the expert. And, I'm not saying either, too. Let's not get it wrong. It doesn't mean I know everything. It doesn't mean I always get everything right either. But I know how to get situations corrected. I know how to get things done. And if I don't have the answer, I know how to get the answer from, a group of people that will know the answer. So, but I love it. That was one of the things that always stuck out for me was your card.
Yeah, and not to belabor the point, but the notion, I love that you put real estate expert on your card because it's there. You've got to live up to it every day, everything that you do. And it also, getting back to the education piece, that too. I sort of chose that path, and I'm going to teach along these subjects, and I can't tell you, it's the determination to be accurate, be up to date with the information that I'm instructing real estate agents on, makes me such a better loan officer. And I see it virtually on a weekly basis, at the very least on a monthly basis, that something I learned in the research I did to stay current with the classes that I teach helps me smooth out a situation, get a loan to closing that wasn't going to get to closing otherwise, take a loan that someone else denied, get it to closing. It all dovetails. You just have to keep stretching. You just have to keep, expanding your horizons in this business to continue to excel.
Yeah. And, you have a way about you that is comforting to clients. I've worked with other loan officers. They're good at what they do, but they don't have a bedside manner. And, that comes into where the customer service piece is. And when you have a first-time home buyer that doesn't understand the process and you're just throwing a bunch of shit at them in acronyms and they have no idea what you're talking about, they're nervous because you've requested 20 things from them, to get them through underwriting. And that really, even though those 20 things are 20 things, they could probably be cleaned up with 5 different forms or something. You're able to walk them through it because you've already walked that walk thousands of times with, first-time home buyers, and it's great. One loan officer I was using for some of my deals with first-time home buyer, he was great at getting the grant done. The problem is he didn't communicate with the clients. Yeah. Every deal that you and I have done together, you've been at the closing table. So it's great. I think there was maybe 1 or 2 during COVID that we did that, we were, because we just couldn't do it. But other than that, pre and post COVID, you guys have always been there. So.
Along those lines, it's, myself personally as a personal rule, and the people on my team all operate under the rule, no jargon. Okay, there's a lot of jargon in this business. LTV, Fannie Mae, the alphabet soup, FHA, VA, USDA, a DTI. We don't talk that jargon. I don't say DTI, I say it's a debt to income ratio. It's the percentage of your monthly income that you're spending on that house payment. If it goes too high, we have issues, and, different loans will go to different levels. And, this is why we're doing the loan that we're doing, because of your situation. And it really pays off. It is, I'm always trying to view what I'm doing from the other side of the table. I know this stuff cold, but they don't. They've done it never. They've done it twice in their lifetime, maybe. So you just got to break it down into plain English.
Yep.
And it's not always so easy, I got to tell you. But you got to make that effort and that's what keeps the customer comfortable. And as well as I do, Mike, if they're smiling at the closing table, they're going to give referrals down the road, and that's
Absolutely.
Really the goal. And if they're smiling 3-4 years from now because they're happy with the house and they're happy with the decisions they made about the loan, that's where your longevity in this business comes from.
Yeah. So that also brings me to this too, Bob. So, look, we have a lot of talk about, buyers, new buyers, this, and that, buyers. But you brought up, people don't do this every day, right? So they buy a home once, they may not do it again for another 12 to 15 years. I wanted to have you on because I think that you're such a great educator and you're great at explaining things. I want to talk about what's important when we're dealing with sellers out from a mortgage broker standpoint. What do the sellers really need to know, and what should they be educating themselves on?
What they need to know, if you're considering selling a house at this moment in time, you do have a few things that you need to consider. Um, one is the current rate situation and how does that affect you as a home seller? And then I want to talk a little bit about the NAR settlement and how that might possibly, benefit, hurt. What are the risks to a home seller once that goes into effect? And again, I know I'm using jargon here, but NAR is the National Association of Realtors. They were just involved in a very large lawsuit where they lost and made a settlement that we're waiting on the court. It's a class action lawsuit, so the court has to approve the settlement that they made with the plaintiffs. But let's just sort of backtrack to where the market is now with respect to a home seller. So a home seller has a goal. The home seller's goal is to sell their house, for top dollar. I guess, are we there? Are we at a point, where home values are peaking? And by that I mean this: very seldom do home values go down. Yes, those of us that are old enough to remember, we lived through the financial crisis. Home values dropped 20%. That's a once in a lifetime occurrence. Maybe happened during the Great Depression, 70 years before. Actually, no, I take that back. The Great Depression, like 80 years prior to the Great Recession and the financial crisis. But we're unlikely to see that happen again. We will see home prices, rather than what they've been doing, going up 9%. I think it was 22, 6% in 23. That's home prices going up faster than other forms of inflation, faster than wages, which hurts affordability for buyers.
Yep, we're outpacing it.
Yeah, and typically, what you're likely to see is, they've inflated, and now at some point they have to moderate. They may pull back a little bit. In the typical pullback, you might see 2-3% regression in values before they start to pick up again. Unlikely to see what you saw during the financial crisis again, not for a very long time. But what's happening is this: hey, is it a good time for me to sell my house? And honestly, the answer kind of comes down to interest rates. You don't necessarily think of interest rates affecting a seller. You think of them affecting a buyer and the interest rate they get on the mortgage. But there's something kind of strange going on in the market right now that's been created by interest rates. And it's this. Back during the financial crisis, and I'm sure everybody remembers this, interest rates went down because the economy weakened, and they were further pushed down artificially by actions from the Federal Reserve and other government agencies. And interest rates were at 2.5, 2.75, 3%. So the whole world refinanced, and and home values went up, because here's what a normal market looks like. Normal market reactions. Interest rates go down. So, your monthly mortgage payment on a $300,000 house, that goes down too. So now that $300,000 house with if you're minimum down, maybe a $2,500 down payment or monthly payment, that monthly payment might go down to $2,000 or $2,100. So now, because your dollar goes further in terms of monthly payment, you can bid higher. You can go higher in sale price on the house and still have the same monthly payment. And that effect means that when mortgage interest rates go down, home values typically go up. So what's happening today? Why is it that mortgage interest rates are up and so are home prices? Home values have gone up as well. Just the push of inflation has a little bit to do with that. But the other dynamic that's happening is this: that someone who might normally be a seller in this market, someone who, bought a house, had 2 kids, bought a 3-bedroom house, then had a third child, then had a fourth child. They're still kind of shoehorned into the 3-bedroom house. They say, oh, time to move up, time to move to that 4 or 5-bedroom house. But when they look at, I have to go up, up $75,000, $100,000 in value. I have to take a bigger mortgage at a higher interest rate. Wow, that's a big leap in monthly payment. So we'll make do. We'll make do for now. They're not selling their house. Someone else in a sort of a different place in their housing career. They're an empty nester. They want to step down to something smaller. And they look at it and say, hey, we've got some nice equity here. We'll sell the house. We'll make a nice down payment on a smaller house. And yet, because mortgage interest rates are higher, they could be looking at a monthly payment that's the same or even higher on a smaller house than what they've got now with that 2.5% interest rate loan. So people are staying put. But what hasn't stopped happening is what we call household formation. People are getting married, want to buy a house. People are, living in apartments, having babies, want to, move into a house, don't want to raise their kid in an apartment. They're living with their parents. They want to move out. So households are forming, but people aren't selling their homes. So, supply and demand being what they are, there's not a lot of supply of homes for sale. There's a lot of people that want to buy a house. And what you're seeing is an attractive house goes up for sale, 10, 15, sometimes 30 people bid on it, and that's pushing the prices higher. So strangely, in this world where normally higher interest rates result in decelerating or even declining home values, that's completely on its ear right now. The very low interest rates of a short time ago combined with the high interest rates today are causing people to not sell. So supply and demand, there's not enough supply. The demand is pushing those values up. So yeah, it's probably a good time to sell. Are we at the top of the market? Is it time to, okay, now let me look at my crystal ball, says the market's going down, market's leveling off, let's do it now. Perhaps so. What you're likely to see in the future, and Mike, stop me. I know I'm
No, you're good.
I start geeking out. On the economics.
You're the number guy. So
here it comes. It's only going to get worse.
When you're on that, though, right? So here's the other thing too. What I'm thinking about this. So when we were sitting at the 3% range, and everybody ran out to buy a house, and we were 30,000-40,000 over. So now, we had an inflated housing market, 17% year over year with COVID, the value of the homes. So right now would probably be a decent time to sell because rates are good. But those folks that the folks you're talking about, the empty nesters, that, becoming, or people typically move within, 12 years, give or take. We don't know where the rates are going to be. And if rates are 7, 8, or 9%, which, we're going to say that that's been the 20-year range anyway, or maybe even the 50-year range, give or take, some oddities. But who's going to want to give up that 3% rate, even in 12 years from now?
At some point you have to, okay? And that's, if rates stay where they are, the market, this imbalance between supply and demand is going to be a slow thaw, okay? And eventually it will correct itself. But if rates stay where they are, then it's going to take at some point, the family of 6, 2 parents, 4 kids in a 3-bedroom house, they're just going to get to a point where they just can't deal with it anymore, and they have to move. So they'll make that decision eventually. Everyone's putting it off, okay? The empty nester, people age. Can they handle the steps anymore? They may die. I mean, that's part of the life cycle, right? Yeah. So eventually these homes will turn over, and eventually over time, enough people will have bought, in the 6s and 7s that, that move up house, if rates are still in the 6s and 7s, isn't the huge step up in monthly payment that it is to someone going from 3% to 7%. So yeah, if interest rates don't change, there's going to be a slow thaw in the market.
Yeah, I think very.
That said, if they do, depending on who you ask, this notion of I'm not giving up my 3%, I'm not giving up my 2.5%, but at some level, you've got the pressure of this house doesn't suit my needs anymore, and then you've got the monthly payment on that move up house maybe coming back to you a little bit because interest rates are going down. Where's the point where that breaks loose, where the dam breaks? And, it varies depending on who you ask, but the number is probably somewhere between a 30-year fixed rate of 5.5% down to 4.5%, where people say, that's it, low enough for me. Got to get out of this house. Just not enough room here anymore. Good enough for me. Got to get out of this house. My knees just can't take the stairs anymore. I got to get to that, over 55 on one floor. So the question is, when is that going to happen? And what does that mean for a seller? How do you time your decision? Now, if you're following the financial news, you're probably aware that this morning, the consumer price index, the inflation reading, came back a little higher than expected, which is probably an indication that we're going to see interest rates higher for longer, as the Fed's kind of been warning us these last couple of weeks.
Can we quote you on that?
What's that?
Can we quote you on that?
You can quote me on that. I can quote Jay Powell. Jay Powell said higher for longer. People weren't necessarily listening, but that said, that moment where we get to 5.5%, that moment where we get to 4.5% has probably been pushed back a little bit. Look, I'm someone that always is out there rooting for bad news. One thing that pushes interest rates down is a good financial crisis, a good bank failure. So everyone, please go out and withdraw your money from the bank. And but I'm joking about that. But the dynamic that's likely to happen, again, we've got a market that's kind of on its ear. So that moment when we get to 5.5%, we get to 4.5%, and the people that have been holding back on selling make that decision. Again, lower interest rates typically result in higher home values, but that's likely to be reversed, just like it's reversed now. Right. The higher rate is choking off supply, which is, demand is pushing home values higher. When we get to a moment where the people that have been holding on to those low interest rates loans and, ignoring their housing need, making do with a house that doesn't meet their needs anymore, the moment that they start to make the decision to move, now things turn around. Now you could have more homes on the market than there are people looking for homes, which, again, supply and demand being what it is, could cause home values to stagnate or even backtrack a little bit. Totally contrary to normal economic dynamics, right? As I said, normally rates go down, values go up. But that, the exact opposite is likely to happen as rates moderate. So, yeah, is it a good time to sell? It probably is. And if you time it reasonably well, you don't have to time it perfectly. You shouldn't try to time it perfectly. But if you time the sale of your house reasonably well, you'll sell it. You'll get, top dollar for the economic conditions. If values moderate, then in the future, when the opposite dynamic starts to happen, interest rates come down, which creates more supply than there is demand, then you're somewhere where you want to be in a house that meets your needs with the opportunity to refinance down to the lower rate. So, yeah, I guess, and I will say, Mike, a lot of this is unscripted. I'm kind of talking to myself.
Yeah, no. I prefer it that way.
Now's the time to sell. But, I think that ideal time is not that far off, and can I do my screen share and really geek out and show you what I think?
Before we get over to your screen share, one thing that you had said was, which is, I think, a great dynamic, especially with this whole NAR, buyer's agency, bundling, and everything else. When we get to the point where, right now it's still it's a seller's market. When we get to the point where it's a buyer's market and we have more inventory than we do buyers, this is where the buyers are now going to be able to negotiate those buyer agency agreements back into those seller concessions and the loans, because the
Yeah.
sellers that all don't want to pay a buyer's agent's commission now.
Mm-hmm.
There's going to be an influx of houses on the market. Well, they're going to be kind of stuck contributing it
Yeah.
somehow, whether it's actually paying for it or giving a seller concession or reducing the price of the house so they can put less cash down. But I think that's probably what we're looking at. And then you're right. At the end of the day, all of this balances out anyway. It's the cycle of life. And, after the big financial crisis that we had with the housing market, 2008, it's very hard to believe that our government will let the housing market fail and crash again like this. When we watch what they did with the bailout with the big three, the automotive companies, and the banks that they've been bailing out, I don't think we'd ever see a complete crash the way we were back then. Be some disruptors in the market, but I don't think we'll ever see that again. I think government's going to help right side everything, and we're just going to be fine. And I know, I posted this thing the other day about Chicken Little with the NAR coming down and chickens running around, and everybody heads exploding. Everybody's in a panic, so everybody relax, take it easy. We're going to be all right. So, Bob, I'm going to flip over here so that we can put your screen up.
Yeah,
And
actually, you know what? Forget the screen share for the moment, because I do. You brought up the NAR settlement, because I think that is a dynamic in the future that anyone that's considering selling a home now or this summer, this year, this NAR settlement dynamic factors into their decision, and it's something that they need to consider. And you touched on the points. So for those of you that don't know, and to the audience that's not in the real estate business per se, NAR is the National Association of Realtors, and what has happened is this: it's been the longstanding tradition of the National Association of Realtors, and keep in mind, it's an association. It is not; they do not make laws, but they set rules for their members. And the vast majority of people with a real estate license are members of the National Association of Realtors. And not only do they set the rules for their members, but they also control the multiple listing services. When you go on Zillow and you're looking at homes, what you're really looking at is you're looking at data that was pulled from a multiple listing service, which is the place where real estate agents list homes and look for homes list homes for their sellers to sell and look for homes for their buyers to buy. So the National Association sets the rules around what members can and can't, should and shouldn't do with regard to their practice of real estate and how they use that MLS. And what happened years ago? I mean, I don't know when the rule went into effect necessarily, but it was early. It was the 20s, 30s, 40s, and what the association saw was this: that in a real estate transaction, a seller had the upper hand. They had experience. They've owned a home, they bought a home before, so they knew the process better than the buyer, who, oftentimes is a first-time buyer. They had equity in the home, which meant they had money, something that a buyer might not. Buyers, sometimes are really scraping together to get every last, nickel and dime that they need to make their down payment and pay their closing costs. So the National Association, seeing that sellers had this upper hand, made it the rule in a lot of places that, hey, we control this multiple listing service. If you as a real estate agent, to sell your house for top dollar, you have to list it there. You got to put it on that MLS. And if you're going to put it on the MLS, our rule is that you, as the seller and the selling agent, have to pay compensation to the buyer's agent so that the buyer has representation. And it was something that started as their attempt to level the playing field. And I think it did. And I don't necessarily think it was bad. But it got to a point where it was, it's an association of realtors. It's not the law. They're negotiable numbers. You could say, sure, I'll pay you, 3% to sell the house, and I'll, throw 1% or 2% or 3% at the buyer's agent, so that buyer can have proper representation. The custom became so deeply ingrained the people thought it was the law and didn't think they had a choice and really weren't being told otherwise. So as a result, the attorney got a hold of it, got some home sellers who felt like they were wronged, sued the National Association of Realtors and said, hey, this isn't fair. Our folks selling these houses didn't know they had a choice. And as a result, they were harmed financially. And the court agreed. It was a huge settlement, $1 billion something dollars.
Right. Yeah.
NAR came in and renegotiated and said, hey, look, let's cut the number down. And in return for cutting the number down, we're going to change some rules. One of the big rules is this, that in order to list your home in the MLS, and this is due to go into effect in July, it's a fairly fast transition to what some of the things they're proposing. So it's likely that date will get pushed back, but it may not. So starting July 1st, a seller who lists their home will not be required to offer buyer agent compensation. In other words, to pay the commission for the buyer's agent in order to list their house in the MLS. They can still choose to, but it won't be mandated. And a lot of sellers will take that up with the thought that more money for me, right? If I don't have to throw another 2 or 3% to pay the commission for that buyer's agent, let them pay their own commission. More money for me. And it may very well work that way. And in an extreme seller's market, that's likely how the dynamic will take effect. But maybe not. If the market starts to shift more towards a buyer's market, more towards a balanced market, then sellers may find that, people just aren't. And by the way, you can't advertise what you're paying. That's another thing that's in the MLS now. They're not going to be able to advertise anymore.
But you can
in the MLS.
You can on your own private website.
You can
on their company.
And there's plenty of those. So the information will be out there.
Yeah, MikeRady.com. It's the only place for a house.
Yeah, go get the information. And the likely effect is this. Again, supply and demand, right? The more people are demanding that house, you've only got one in supply, my house, the more people want to bid on it, the higher the price is going to go. Well, if you're not going to offer that buyer agent compensation, if you're not going to pay for the representation for the buyer, any buyer that doesn't have the money to pay it themselves, and oh, by the way, veterans, people who are seeking VA loans are disallowed by the loan program, disallowed from paying as a buyer agent commission. So you're taking all the vets off the table right off the start, right from the bat. So you're going to have fewer people bidding on your house and would likely not get as high a price. Again, that dynamic, in an extreme seller's market, maybe it doesn't work out that way. And in many cases it won't. But as the market comes back around to even, or maybe even a buyer's market, they're going to want to do that. And there's more, Mike. I mean, it's not just the notion of, representation, but, you also have to consider, are you putting yourself in some type of legal jeopardy? And by that, I mean this, that, whoever you ask, any real estate attorney, experienced listing agent will tell you that, an unrepresented buyer, and people are going to do that. They're going to say, I can't afford to pay for my own representation. So I'm going to call that listing agent. I'm going to go it alone. And the listing agent's going to be very clear. I don't represent you. I represent this seller. I'm a real estate professional. Like, I just can't afford it. Here I go. And, if once they own the house, they turn up a defect in the house, there's, feel misled somewhere, they're likely to sue. I'm sure they'll have an attorney that'll pick up the case. And, so you're at a greater legal jeopardy because, the motto goes that, the lawsuits start with the unrepresented buyer. So from the standpoint of protecting yourself legally, perhaps it's still wise, no matter how unbalanced the market, to pay that buyer agent compensation so that they are represented, so that you're shielded from that potential lawsuit. I talked him out of the home inspection, and
Yeah.
never found the correct foundation. It's things, and those things will happen.
Yeah.
So it's probably wise to do. Again, not everybody will, not everyone will find it wise, but I think in the long run, it is wise. The and another thing, and this is the other thing that I think is really important, is a buyer's agent. When someone comes to you without a buyer's agent, that buyer's agent has been a filter for a lot of things. That buyer's agent has, put them in touch, hopefully, with a good, competent mortgage loan officer. Someone, and look, I work with Mike. Mike, thank you so much for the kind words, and the fact that you came to me when you needed a mortgage is just heartwarming. It's sort of a validation of everything that I do, because Mike talks to a lot of mortgage people. But more to the point, we're not all created equal. I was a rookie at one point, and you know where I worked? I worked at a place. It's just like the online lenders of today. I won't mention their names, but I made a lot of mistakes, and I passed out a lot of pre-approval letters that I shouldn't have because I didn't know what I was doing. And as a result, people are going to respond to the sexy advertising. They're going to come with that pre-approval letter that maybe they never should have gotten. A seller's going to accept their offer, take their house off the market, agree to do home inspection repairs, maybe $2,000-$3,000, and then a week before closing, the loan gets denied, and the whole deal's dead, and they've been off the market for 45 days.
Yep.
So you need. You as a seller need a represented buyer to protect yourself against the legalities, against the unknowns. That they need that filter. Okay, they need that filter of advice. They need that filter of, I need to put you in touch, with the right mortgage person. I need to put you in touch with the right home inspector. Everyone knows who Henny Penny is, right? The sky is falling. There are some Henny Penny home inspectors out there.
Oh, certainly.
Yeah, the right home inspector is the person that facilitates, right? This, hey, see this house, turn around and run. There's so many issues here, right? Yeah. You want to be protected against that. But at the same time, you don't want the home inspector, who makes a mountain out of a molehill and scares someone away from a house that for $1,500 of repairs or $2,000 of repairs, which perhaps the seller is perfectly willing to do, the house can be made right and it's perfectly fine and suits your needs. A good agent, agents work based on relationships. If their mortgage people are doing their customers wrong, that hurts them. That hurts their ability to get referrals down the road. If their home inspectors are doing people wrong, again, it's going to come out and it's going to hurt their ability to get, referrals down the road. So one thing that I always say to a home buyer is your best defense against all the unknowns in the home purchase process is the relationships that the agent has. They have filtered out the people that don't know what they're doing, that don't protect you, that unnecessarily scare you, and so forth. Anyway, I'm kind of off track here, but the point is that you as a seller, you need that filter. It's worthwhile to pay some form of buyer broker compensation. Number one, to attract more buyers, and number two, to not attract the unrepresented buyer that either sues you or hands you a bogus pre-approval letter and you keep the house off the market only for a deal that doesn't go to closing. So
sound advice. Definitely.
Yeah. Sound. I mean, that's my piece. And again, so don't think that this is going to be a bonanza for sellers. And I wouldn't base the timing of your buy sell decision on it. It may very well suppress home values by taking buyers out of the market because they can't afford representation. So don't, again, I think the ideal moment, it may not be today, but it's soon, and don't try to time it perfectly. Get it sold at top dollar, take your big down payment, put it down on your next house, and then when mortgage rates moderate, refinance down, and then you're really in the catbird seat You got a big dollar for your house. Now you have a relatively small mortgage that you're able to take down to a lower interest rate. So there you
And
go.
let's not forget. I mean, the numbers and percentages are all over the place right now because the market's
Mm-hmm.
moving and transitioning so much. But there's a large percentage of sellers that are going to be a buyer. So
Mm-hmm.
at some end of this, you're paying for buyer agency. You're paying for buyer agency. It's going to happen.
Yeah.
Some,
Yeah.
end of it, and it's a shame too because the folks that will suffer. We get some deals that we're fortunate enough to get people to the table. They can afford their monthly. They can afford their mortgage. It's the entry level is a little high financially to get in because it's more than renting, but they can maybe get a house for less than what rent costs. But they need that extra help to get to the table, and they're the ones that are going to kind of miss out. So when you're looking at that average, I'm going to say 180 to 300,000. That's probably the market that's going to be affected the most.
Yeah, without a doubt. To the extent that buyers are going to have to pay, their agents' commissions, and it won't be every transaction, it won't be every deal, but it's going to be a lot. And they're the ones that are going to suffer. They're the
Yeah.
ones that are. There's going to be fewer homes available to them. And look, again, supply and demand. The argument can be made that it will harm sellers to the extent that you're not paying a buyer agent commission. That's fewer people are going to bid on the house, and you're going to save yourself a 2% commission and accept 3% less for the house. That's not an optimal decision, as they say in economics. So it's something to consider. The dynamic is definitely going to change, but again, you got to be smart about it.
Yeah. No, I love it. Yeah, it's definitely sound advice. So you're talking about you expect to see rates to kind of pop up a little bit now, with a little bit of a trend, and they're not going to hit. I'm looking at the rates, right? Because that's, one of the things I do so I can talk to my clients.
Mm-hmm.
You and I were talking earlier, like if you do the 50-year look back,
Mm-hmm.
aren't we kind of on point to be where we're supposed to be right now with averages?
Yeah, I mean, you're actually exactly right. If you look at, and they've been keeping data for just about 50 years, if you look at the 50-year average, the 30-year fixed rate, 50-year average is about 7%, which is about where we are right now. So yeah, there's an argument to be made that we are where we belong. Um, I don't necessarily. I think a lot has changed, and the 50-year average is a bit skewed by the late 1970s, early 1980s when interest rates really spiked.
Yeah,
But
these went up to
I believe higher
10.
for longer is the expectation was that the Fed would start to reduce the interest rates that they control beginning in June. That timeline is probably pushed back. Based on the numbers that came out this morning. But again, we still have a couple more things to look at this month. And here I go again. I'm geeking out. So, all right, there's the consumer price index. What are consumers paying for things? Then there's what's known as the producer price index. What are people that produce goods paying for their inputs? And then there's something called personal consumption expenditure, which is what are people actually spending? Well, strawberries went way up, so I'm not buying strawberries. I'm going to buy bananas. They're cheaper by the pound. People start to replace, and even though the price of goods goes up, it's those replacements and those decisions that people make that cause them to spend the same or not much more than they were in spite of the inflation, which incidentally, that's the number that the Federal Reserve looks at most carefully. Okay, because eventually, if you're doing those substitutions, I'm going to stop buying the strawberries because they're too expensive and buy the bananas. The strawberry producers will do what they can to get their price down so they start selling strawberries again. So that's what they look at. And that number has, at least last month, came in at expectation. And if it does that again this month, then we could be back in for an earlier rather than later rate cut. The other number I mentioned is that producer price index. So what you look at is what are consumers paying, what are producers paying, and we've had some months where the CPI jumped up a little bit higher than expectation, but the producer price index came in at or a little below expectation. And it's math, right? If producer prices are going down and consumers are paying more, profit margins are going up. Whoopee, buy stocks, right? That's one of the reasons why I've seen the stock market run, not counting today, in spite of some of this. But that, again, competition being what it is. Why is Amazon so successful? Because I can literally price shop. I can walk into Target and look it up on Amazon and buy the cheaper one. That those margins will moderate in time. Anyway, I'm going way geek.
Yeah, no, you're good though. I know it is deep. It's but it's a financial conversation, and
yeah, it is.
But this is important. I mean, buying a house is a big deal. It's it's a large investment. You're signing up for typically 30 years. And it's part of your roadmap to your future. Where's your money going to be? Where's it going? And you gotta have a little bit of an idea. First time home buyers, we don't go too deep into that kind of a market explanation and stuff like that. We kind of focus a little more on the payment, where they're at, what they can afford, what looks good for them, and on their household, on their first house. But people that are getting into their second, third house, it's where you really start to plan a little more, because now you start thinking about your investments and equity in your house and everything else.
For sure.
Yeah, no, it's great. I love it.
Look, I think the bottom line is, again, don't try to time it too hard. The screen share I was going to show you how we're at this moment in time where the short-term yields are lower than long-term, or short-term yields are higher than long-term yields. And by that I mean this. So you go shopping for a certificate of deposit, and you get on SoFi or something like that, and you see, oh, here's, the 3-month CD is paying, 3.5%. Here's the 5-year CD. I got to tie this money up for 5 years. That's paying 5.5%. So the longer I tie the money up, the higher the rate, the higher the yield. In the bond market right now, that's upside down. And I'm looking at it here. The 1-month U.S. Treasury bond is yielding 5.379%, and the 10-year U.S. Treasury bond is yielding 4.546%. So short-term yield is 0.8% higher than the long-term yield. That's the market telling us, yeah, interest rates are high now.
Right.
1-month yield, 5.379%. But our expectation is, and I'll give you the 2-year yield, 4.973%. In 2 years, these rates are going to be down. That's what the market's telling us. And if the market, well, why are they so smart? Yeah, they are. They all went to MIT. They all went to U Chicago. They all went to Yale, and there's a whole bunch of them noodling this thing. So, it's no one of us is smarter than all of us. And, those market participants are some of the smartest people in the world. So that said, yes, those lower rates are coming. So, if you want to catch the crest of the wave, from the standpoint of a seller, this might be it. And again, if this isn't it, it's coming very soon. Yeah. And that's what the market's telling us here. Don't try to time it. Don't think the NAR settlement, if you're reading about that, is this panacea that's going to help you put a bunch more money in your pocket. It may very well be just the opposite. So make the right decision for now. And the right decision for now is, at least what the market's telling us, sell, you'll get top dollar, you'll get into whatever you get into, and maybe that higher payments, a tight squeeze, but in the future, the opportunity to refinance is coming. So says all these really smart people, trading bonds on Wall Street.
Yeah, no, I appreciate it. Bob, do you have the graphic of your contact information there, or?
I do. Now I'll do a screen share. Here it comes.
Bring that
coming
up.
At you. Let me find the right one here.
Your bond share.
No, that's my bond. I shared the bond. Hold on a second.
Yeah.
Let me stop sharing.
I promise Bob is better at money than he is technology.
How's that?
All right.
Oh,
Perfect.
wait, I got to get this out of the way. Bang. There we go.
There we go.
That's me. That's where you can reach me. It's I'll read it to you, 856-341-6636. I'm Loan Officer Extraordinaire on Facebook. You can look me up there. Local Lending Pros, another handle that we go by, and you can find us online.
Yeah. So agents, that are listening and watching, reach out to Bob. He teaches a great CE class. I've taken a couple of them. Bob runs a weekly Next Top Agent. I guess you're going to call it a webinar or
webinar. It's a Zoom call every Tuesday morning at 9.
Every Tuesday morning at 9. It's a great call. He's always got a nice guest on. He's got like a sponsoring company and then a guest, and they talk about stuff related to our market and what we're doing. So Bob is constantly giving back, and it's definitely much appreciated. So Bob, thank you very much. Everybody reach out to Bob. Bob's contact information will be down in the notes and everything else. And I appreciate you coming on, buddy. And I'll talk to you soon.
Hey, thanks for having me. It was a pleasure being here.
All right, Bob. Have a good one.
All right. Thanks, Mike.
All right, everybody. So we just wrapped it up with Bob. Let me mute him here. So, yeah, it was great. Not typically, we don't go that deep into stuff, but I thought it was kind of important. There's a lot of big things happening in the industry. And when I say the industry, I mean, it's the real estate, it's the mortgage, it's the banking, our economy. Bob is a true, loan officer extraordinaire because he has that financial background. And Bob's a trusted advisor to me, to my family. He's who we go to when we have mortgage needs. All right, so just a couple things coming up. On April 25th, we're going to have a husband and broker team from Washington State coming on. They're going to talk about NAR. And the reason why we're going to do more discussions about NAR, I know everybody wants to throw up over that shit already because you heard enough. But the reason why we're going to talk about it is they're out in Olympia, Washington. Washington State has started with the buyer's agency agreements. They changed the laws. I mean, we've always had buyer agency agreements here, but they've changed the laws back in Washington in January. So we're already behind the 8 ball. The rest of us have got to catch up now. So these folks with their brokerage out there in the northwest part of the country, they've been doing it. So they've already hit all the obstacles. They've hit the road bumps. So they're going to come on. They're going to advise agents how it works. They're going to talk so buyers have a better understanding of why they need the buyer's agency agreement. They're going to talk to sellers so sellers understand why we need the buyer's agency agreement. So don't forget, check it out. What's going to be on April 25th at 6 p.m. We'll be on YouTube Live, Facebook Live, LinkedIn Live, Instagram Live. We're not on Facebook Live today because I said something on Facebook that Mark Zuckerberg didn't like. So I'm not allowed on for like another week or so. But everybody, thank you for tuning in. I'm Mike Rady. This is the Get Seen, Get Sold podcast. Find us on Spotify, iHeartRadio, Amazon, Apple Podcasts, and Get Seen, Get Sold.
All right, renegades and rulers of reality. That's a wrap on another ruthless round of the Get Seen, Get Sold podcast. Stay wild. Stay wild. Keep your listings lit and your negotiations nasty. Until next time, don't just get listed. Get seen. Get sold. Drop the mic. We out.